Well, greetings. As we move towards a new year, and I continue to address topics that are of significance when it comes to exit planning, I just wanted to take a dive into a topic that somebody might look at and think, okay, well, you're a fractional COO. Why are you talking about the budget development and control process? Well, admittedly, this is an area that I have a lot of experience with. And even though I have a lot of experience with COO type of tasks, um, because of my tenure as president of an organization for about a decade, I also managed to develop a lot of experience and expertise when it comes to CFO topics, just because of work that I did there and in other organizations. And really, at the end of the day, the budget development and control process, while it's typically run by a CFO, if a business does not really have one, this is something that a COO is going to really need to figure out really quickly. And since this is a key aspect of getting a business ready, um, this is one topic that I am really grateful that it's not extremely technical and complicated. It's one that if you have a good bit of practical experience with budgeting, with businesses of any size or shape, you can easily figure it out and scale it. Now, one of the reasons why it's so important to address this is um, 42% of M&A brokers in this year have noted that due diligence is requiring longer periods due to sellers not really having the financial systems in place that are required. They're just really are not well prepared. And if you have a strong budget development and control process that is in place, this is going to help you out a lot. Now, there's a really good chance that if you have a weak process, the multiples that you're going to be getting when it comes to the sale are going to be substantially less than it would be if you have a good process. In fact, I think it is a conservative estimate to say that your multiples will be twice as good if you have a really good, solid process in place. So, and you might be thinking, okay, well, this is all fine and good, but I still don't understand why you as a COO are talking about this. Well, let me put it bluntly. Operations really is going to be reflected when it comes to the financials. If you have rock solid operations, really good processes, it's going to be reflected financially. So at the end of the day, the budget, while it may not be officially controlled by the COO, what is going to happen is having rock solid operations, it's going to reflect in the budget just because of the fact that things are going to be very clean, tidy, and really well controlled. So that is why I'm wanting to delve into this topic, and I feel like it'll be really helpful. And my encouragement is if you are a business owner looking to exit, that you give some serious consideration to what we're going to be talking about today. And in case you're wondering, no, I am not going to be viewed. I do not want to be viewed as the Dave Ramsey of the exit process, just because of the fact that really what I'm going to be talking about here is going to be completely different from the type of stuff that Ramsey likes to discuss. So, having said that, let's go ahead and take a quick dive into today's topic, which is budget development for exit ready businesses. Now, again, I've had a good bit of an introduction here and really just want to thank everybody for coming out to this. And really, the goal with this is not really to get too deep in, but it's really to get you to start thinking about things and realizing that, while there's going to be a lot of work that's going to be involved in this, the results are going to be substantial. And the beauty of this is that this is very interrelated to a lot of the other work that you need to do when it comes to exit planning. So it's not like, okay, this is going to be the only thing. It's actually going to be dovetailing nicely with a lot of other stuff that would be going on. But today, I felt like addressing this topic in isolation would be very helpful for us. So, having said that, let's dive into the topic at hand. And let's just start with the $2 million question. And while I'm just picking out this arbitrary number as the $2 million question, it could actually be substantially larger. Why is it that two identical businesses who have the exact same EBITDA sell for dramatically different prices? You literally could have a business that one business that sells for 40 million, same EBITDA, and another business that sells for 15 million. That's a lot of money. And you might think, okay, industry, that could have something to do with it. Yes, industry will have a significant impact. But even within the same industry, this could happen. And a lot of it would stem from the fact that, one business found a really good buyer and were willing to pay a premium for a business that was really valuable. That $15 million buyer, it's probably a financial buyer, like a PE firm that is coming in wanting to just pay something, essentially buy at a steep discount just because that the business isn't ready. Now, let me ask this question for everybody. And I'm obviously not going to be able to take an effective poll here, but I just want you to ask. I'm going to ask this question and just let it sit for a few seconds. Could your business operate profitably for 90 days if you were completely unreachable? In other words, life would go on. Basically, when it came to financial decisions, as far as purchasing, it was clear, okay, this is what could be purchased. There is an approval process in place for if a special purchase needed to be made, or, you had somebody who was able to forecast your cash flow and be able to say, okay, this is what the process, this is where we're going to be in 90 days when the owner gets back. And not only that, but also in addition to that, we will have monthly closes where we're able to just completely close out the books and make sure that everything is ready for the next month. Now, can that happen if you were to walk away for 90 days? If you have anything other than yes, it can, this webinar is for you. And that is the reason why this is so important with this budget development and control process, is because while obviously this is not necessarily directly tied to operations, if you do not have these controls in place for making sure that, everything that is allocated towards certain things is spent properly, any special expenditures, okay, they get signed off on somebody. And, even, the budget process showing, okay, forecasting as well as okay, how is our budget actual? If you don't have all of this happening and people, reviewing it, studying it, trying to figure out where things are going and, maybe even make adjustments, the reality is if this cannot happen when you are gone, now you understand why you're going to get a valuation that is substantially lower. Now, here is the reality when it comes to exit readiness. And it's not a pretty reality just because of the fact there's a lot of hard work. If you answered anything other than yes, I believe this business could function for 90 days, you are not ready. It's not a matter of like, well, you're almost ready. It's a simple yes or no question. If you cannot have a business function for 90 days without your presence, you are simply not ready to exit. That's really as simple as it gets. So here is then what we need to take a look at is we need to really get down to the nitty-gritty of what it takes to be exit ready. Now, 95% of middle market businesses show excessive owner dependency. That is really the number one value killer identified in exit assessments. Now, let me be clear, not deal killer, value killer. The reason why is private equity firms will be willing to give you a low offer and then come in, reorganize everything, and then basically flip it at a profit. So, what's really important here is a lot of the stuff that we're talking about today, it's not like it's going to necessarily kill a deal. There's going to be stuff that we're going to talk about that absolutely could kill a deal, but this is the type of stuff that is going to drive down the value of your business substantially. If you were looking at this as being a nice retirement nest egg, well, you need to really, really latch into this because this stuff is critical. Budget accuracy is now really a core due diligence item. Quality of earnings reports are going to be standard for transactions for above 5 million, which means that, if you want to make sure that, the quality of earnings is going well, I can tell you there are going to be some red flags if your budget to actuals are consistently showing major misses. Now, the way I have always liked to run things, especially when I was president, I always liked to, okay, have a budget, but if there were ways that we could kind of find the fat and not spend as much was allocated, I always like to do that. And I mean, I realized that there were some times you just absolutely had to spend the full amount. Um, but if you're when push comes to shove, what's important is our budget and actuals need to be really close. Misses either ways that are substantial and consistent, you know, those are not going to be looked at well. And again, the budget is really a good tool for showing us as far as where we stand. So, if we want to make sure that we're in a good position consistently, making budget and being accurate, relatively accurate is key. Now, here's going to be some potential scrutiny. But buyers are going to be looking at 3 to 5 years of budget versus actual variance history. And, you're going to need to have documentation. And, obviously this could expend to AR and AP aging explanation for why things are over 90 days. But the reality is, if there's a lot of variance that you're having to explain, that's a problem. In other words, the less you need to explain with your variance, the better. If you're only having to explain, okay, yeah, we had a slight miss here, we had a slight miss there, um, that's going to go a long way. It's going to show that the process that you have in place is one that is consistent and it is as accurate as possible. Now, additionally, the financial controls that we talked about are going to demonstrate the business is able to run independently of the founder. If you need to approving every single purchase any department makes, that is a big problem. Aside from sounding like being a bit of a control freak, the reality is if there is no process that's able to streamline things so that way it's like, okay, this department needs to make this purchase, this department needs to make that purchase, they have such and such amount allocated to it, and everything is streamlined so that way it's clear the control mechanisms are, oh, they're about to go over so they can only pay this amount and they need to get special permission from somebody to do this. If you have stuff like in that place, that is going to give a buyer a lot of confidence just because they see a mature organization where people realize there are clear guidelines when it comes to purchasing. And not only that, but also a lot of things can be done without having to go all the way up to the top in order to get approval. So those are some important things to keep in mind. Now, what we want to do is we want to focus specifically on budget deal killers. And these are going to be things that are going to show up in a budget that are going to completely tank what you're trying to do with the sale. So first off, let's take a look at the real valuation consequences and really the impact of weak financial systems. Some of the items here that would fall under these valuation consequences are inconsistent financial records or unexplained revenue fluctuations. I mean, I get it. Revenue is going to fluctuate. And in fact, when I developed a statistical model which was aimed at predicting cash flow on a quarterly basis, the closest it was able to get was usually within 3 to 4%. So, if you're within a margin of error, there's no problem there. But if you're, having misses by like 20 or 30%, you really can't explain it. You have no idea why you did something. Uh, or it could be, now, obviously, if, like, say, for example, let's say you decided to do a special um, promotion with a discount. And I will say one thing I have learned is people love discounts. And if you have a promotion that runs for an extended period of time, people will eat it up. But if you can't explain, that's okay, that was clearly what a major revenue driver was, you know, that's going to be killing a deal because it shows the buyer you don't know what's going on financially. Budget assumptions that can't be defended or validated. Why in the world do you think that this upcoming year you're going to have a 50% surge in revenue? Do you actually have something to verify that? Now, if you actually have a marketing plan that you believe is going to be targeting channels that you've identified as being successful, you have a lot that's going to be going into that, and you already have a lot that's been going in, and you believe that the ROI is predicting a huge um, jump next year, that's one thing. But if you just say, well, hey, we believe that that's going to happen, and there's just no documentation establishing why. Um, yeah, business owners don't like buying fairy tales. Significant variances without root cause or documentation. It's like, okay, if you don't know why things are varying and understand it and have no documentation, yeah, that sounds like a disaster waiting to happen. And then in cash flow projections that are disconnected from operational reality. If you have a system where you have a lot of invoices greater than 90 days in aging, that is going to be a big killer just because, invoices that, hit that 90-day aging threshold with they're the ones that really tend to kill your cash flow. And I know because I worked with a manufacturing company once that had a lot of invoices that made it 30 plus, 60 plus, 90 plus days, and that's when you start having really great profit and loss statements, but the cash flow is just showing that it's just not coming in. So that's another example of how you can really get messed up. And while that's not necessarily per se what this is talking about, that's an illustration of how cash flow issues can really louse up a deal. Now, other quality of earnings landmines that fall into this is revenue recognition that recognizes inconsistencies across periods. If you're way up, way down, way up, way down, I mean, obviously there are seasonal businesses out there, but if there's no attempt to boost business in slow periods, and your quality of earnings is going to be showing a lot of this, that's going to be a deal killer. If you've recently made changes in accounting practices and there's no explanation, that's going to be a deal killer. Now, I will, one thing that I like to do is I have an assessment that I give called the GAAP accounting assessment. And what it's designed to do, it's not necessarily designed to see how close to GAAP accounting practices you are. It's just designed to see, okay, is there any method to your madness when it comes to accounting? I have never actually used GAAP accounting specifically. Um, but a lot of the principles there I do hold to, and the reality is if you're going to be getting a business ready to sell, getting GAAP accounting set up is obviously going to be a huge plus. Heading in that right direction, building towards consistency and accountability, that's also a big plus. Really the big thing is just making sure that you know you develop things that are consistent. And, if you have an explanation that, we did a comprehensive audit, we found inconsistent practices, and we tried to correct them. So now things are going to be much more accurate. That's going to be an explanation that's going to sit well with a business owner, especially if they saw a lot of work was done historically to correct the record. And then, of course, another big thing is financial statements that just don't reconcile to bank statements or tax returns. I mean, that's a huge red flag. And on this topic, I remember recently a question that was posed to me is a business was doing the accrual basis for their accounting and the cash accounting for their taxes. Um, Honestly, I feel like the biggest thing to say on that point is like, no, that's a no-no because that's going to make things super confusing. Even if everything is completely accurate, the reality is if you're going to use cash in one capacity and accounting and accrual in the other, it's going to cause you to have different numbers. It's going to cause a lot of confusion, and buyers don't like to be confused. And that will basically end the deal right there. And then another big thing that happens is owner expenses mixed with operational costs. If you bought those season tickets to the Washington Capitals, or you're decided that this is the year that you're going to splurge and get seasons tickets for the Chicago Bulls, or you're like, hey, I just want to celebrate going to a two-time World Series champion, and I bought seasons tickets for the Dodgers. Writing them off as a business expense is a no-go. That's a personal expense, and that's going to cause a problem. You can obviously, I'm not saying you can't buy them. It's a matter of don't write them off. That's a personal expense. Now, the real valuation consequences of all this, well, every unsupported add back is going to face scrutiny, and they're if it's undefensible, it's going to result in an adjustment that's going to reduce your EBITDA. Buyers are going to bid at the low end when they perceive that things are just unreliable or they're not rock solid. Again, they're going to buy at a discount because they realize they need to go in. If there's any takeaway from this webinar that I would like you to have, it's that whenever a buyer comes along and sees you doing something that they know they're going to need to come and correct, they are always going to come and say, yes, let's buy this at a discount. So, having said that, let's take a look at budget maturity. Um, and these are some guidelines, as far as like what you should be doing. If you're at $2 to $5 million in revenue, you should basically at a minimum have annual budgets and monthly actuals. If you're at 5 to 10 million revenue, that's when you should start having rolling forecast and KPI dashboards to start really looking at the nitty gritty from the perspective of what a buyer would be looking at in, say, a valuation report. And then when you get to 10 to 25 million in revenue, that's when you have driver based budgets and then really go into scenario modeling with enhanced reliability. Now, one thing I should mention, I think that, while this is the bare minimum, I personally believe that regardless of what size you are, you should try to have as much or all of these as possible. And the reason why is because it gives you more data points to have clear cut decisions that will be able to point as far as, okay, what you should be doing. And the better the data, the more data points and the more clarity we have, the better position we will be for success. So, having kind of taken a look at that, here is what I want us to think about as far as essentials when it comes to the budget process. The monthly close, hey, obviously 15 to 20 days with written explanations for material variances. The sooner you can get that done, the better. But basically, getting the monthly close process with any variance documentation is going to be key. And, just tightening up to maybe say even 10 days within the close of the month. That would be great. But the key is to make sure that you have timely reporting and that you're able to give detailed explanations for everything. Rolling forecasts alongside annual budgets. Buyers really want to see the discipline of a budget, as well as the ability to uh, have agility when it comes to forecasting. If you're discovering that your revenues are increasing substantially, just greater than you forecasted, and it's because of hard work that's finally beginning to pay off, well, can you adjust that? It's like, okay, well, what do we do? Do we need to hire another person just because we have this um, onslaught of growth? Um, do we need to, what do we do? And if you have the ability, based on a rolling forecast, to see, okay, we see this is where trending is, then you're going to be able to figure out quickly, well, since things are going this direction, we need to do this. Um, and then another big thing, and this is one aspect of that I try to instill when it comes to this process, is department ownership. Managers who can articulate their numbers during due diligence are going to be able to demonstrate reduced key person risk. In other words, if you have departments that are well run with managers who are able to really articulate everything clearly when it comes to um, the budget, you are in so much better position. And part of the reason for that is this: is if you not only have that, but also have everything well documented, so that way anybody understands and knows what needs to happen. That's going to be even more important. But making sure that there's department ownership is a huge step in the right direction with the budget process. Okay, now what we're going to take a look at are some control systems. What are they? Well, um, control systems, they are going to be documented approval workflows with um, key clear authority limits. In other words, you have a certain amount that you're able to spend on, say, supplies for the year, or you've with a special budget for an investment campaign, you've been approved to make certain purchases and it cannot exceed an amount. In other words, it's designated not only what can be purchased, but who can purchase it. So we have that. And then there's obviously materiality thresholds that would trigger an investigation. If if you're supposed to spend 10,000 on something for the year and you wind up spending 50,000, that's going to trigger an explanation. Now, obviously, there will be ways that people can try to embezzle and get around this. I hate to say this, but that's a part of life. There's going to be corruption, there's going to be fraud. But the reality is there are going to be thresholds that are in place. So that way, as soon as they're exceeded, an investigation can occur. My preference would be like, if there's a way that what would be triggered as soon as there's an overage is there would be questions about like, okay, you were allocated such and such. Why have you gone over? Um, so when I say investigations, I don't want you to necessarily think in terms of like it has to be potentially criminal. It could be just simply like, okay, hey, we need you to talk with the leadership team and explain why we have this particular overage that where you've exceeded an amount in the budget. And then, obviously audit trails for all budget modifications, you know, basically document everything. Just, if you decided we're going to modify the budget here, make sure we have it documented so that way we can understand what is going on here. And then obviously monthly reconciliations of financial statements to cash. Um, so really, at the end of the day, the budgets can be really one of the most effective antidotes out there to reducing dependency on owners. And you can see how, just because of the fact that these simple processes take a lot of the financial burden off of owners, where they're not having to make the decisions. In fact, ideally, if you work it out right, It could be basically only the big decisions, or obviously, if there's an overage, then the leadership team would not need to be involved. But a lot of day to day stuff, it would not need to have a major decision made. Okay, so now what we are going to take a look at is we're going to take a look at building the management layer. And this is really important because we're in an era where there's been a move away from middle management. I know that obviously when it comes to cutting expenses and overhead, this is key. But the reality is you have a leadership team, but if you have a larger business, say a business that has even 75 employees, possibly even 50, the C suite, there are going to be departments where it'd be more effective to have things structured. So that way, okay, if they have, say, 15 people that one person has oversight of, well, if we could break that into like maybe say 3 departments, okay, you'd have department meetings with the department heads to get everything on track. And what would be nice about that is that way, you could delegate things much more effectively. If you have 3 people overseeing 4 people apiece, as opposed to one person overseeing 15 people, that's going to create greater efficiency at the end of the day. Um, so this is why it's very important that we give some consideration to building the management layer. And by the way, you might be thinking, why is he explaining this? I mean, this is 2025. This seems like it's rocket science. No, it's not. I mean, a lot of middle management is getting cut. And that is the reason why, talking about having department heads, this is not an idle thing. It's something that should be considered when it comes to structuring, to like, okay, having a team leader, okay, middle management, but at the end of the day, it's going to help out so much more with effectiveness. Now, some of the big pros here is that when the department heads own their budgets, the business demonstrates it can operate with the founder's daily involvement. And additionally, financial transparency is going to transfer institutional knowledge from the owner's head to documented systems. And then finally, budgeted owner accountability creates the management depth buyers require. If you have a budget and basically it's broken up so that way, you know, let's say let's just pull a number out of the air. There are 10 people who are have 10 different slices of the budget, and there's also like obviously one person, the CFO, having the big oversight, and he might be assisted with somebody else. But all that to say is, if you have that kind of distribution and responsibility where it's very clear who controls what, that is going to be something that's going to be very, very favorable to a buyer, because it shows that you have a well-built team that is going to be able to function, and the chances of misappropriation or whatnot, especially with all the oversight, it goes away substantially. I mean, it's going to be always there, just because hey, the world we live in, but the problems are going to be much, much less. Now, building the independent management layer, is the way that we do it is, well, first of all, we need to have the financial professional who is going to be ensuring reporting accuracy. Initially, this would probably be me if there's no CFO, but we would work towards getting a CFO. And then obviously, probably get a controller there to assist them, especially since the controller is going to be looking backwards on stuff. And, as everything is recorded, they're going to be going, okay, yeah, we have an overage here, and they'd be probably working closely with the CFO. Then, okay, let's get an operations leader has the budget accountability. And, these are going to be the operational leaders in each department. It could be, and, obviously maybe a marketing lead as well. Basically, you're going to designate whoever is the leader, and who's going to be responsible for leading the team and just keeping track of the finances that are there. A sales manager is going to be owning revenue forecast and pipeline metrics. That's another example of a good manager. And then, obviously at the end of the day, the department heads can explain all of their P&L variances. Now, let's just end this again with a 90-day test. If you were to disappear for 90 days, would the monthly financial reports still be produced accurately? Would there be any budget reviews that will be continuing? Would any variance investigations happen? This isn't rocket science, and this isn't necessarily hard to do. But if it's not done, buyers are going to ask questions, and they're not going to be questions that are going to be very encouraging to you. They're going to be more like questions that are going to be like, trying to confirm, yeah, we need a deal. We need to just jump from this deal. This is not going to be good. So now let's take a look at, the implementation roadmap. And this is really, if you're thinking of exiting within 3 to 5 years, this is something that you really, really, really need to be giving some serious consideration to now. The first thing you need to do is you need to establish a formal annual budgeting process. Now, when you see annual budgeting process, that doesn't mean, okay, you do it, say, if your fiscal year goes from January to December, you put it together in December and decide, okay, we're going to look at it in January. No, this is going to be something that you're going to be needing to do throughout the year. Not only putting it together, but adjusting, studying, analyzing where any variances are coming. In short, you need to figure out the annual budget process. You're going to be looking at this budget differently every month of the year. And you need to get that figured out right at the beginning. Next thing is, you need to clean up the chart of accounts. Obviously, if you're a business owner and the business has grown substantially, there's a good chance that you have some personal expenses that are on the business, and you need to get those cleaned up, or else, a buyer's going to go, nah, we don't want to buy this. And then we need to begin monthly variance tracking. Could be start out as a simple spreadsheet. Ideally, if depending on the software you're using, you can do this, just because like with the budget versus actuals, it will show you, okay, you're either in the black, meaning, okay, you have not spent all the money that's been allocated towards it, or it could be in the red, meaning, okay, you've had an overage here. Whatever it is, start your monthly variance tracking, and I would encourage it. If you have, most likely your accounting software has something that you can do this, and you can very quickly start identifying those variances. And then, you may not necessarily be able to notate in it. If you can have at least written explanations of it, that would be great. So, now that we've taken a look at that, let's take a look at the next phase. And then really, it's a crucial one, because this is the systematization phase of the budget development and control process. This is where you're like, okay, we've gotten a lot of the good groundwork in place. Now what we need to do is we need to really build on top of that. Now, really, year one, you need to select an appropriate FP&A software. Ideally, what I would recommend is if you could get an enterprise resource program, most likely that is going to have what you need in it. And additionally, it'll also help you out, especially when it comes to controlling programs. One thing I should mention at this point, QuickBooks is not an enterprise resource program software. Now, it is a very, very popular program among small business owners, but it is not an enterprise resource program. It has some limitations. And if you wanted to have really effective management and, especially when it comes to vendors and, controlling other aspects of the business, QuickBooks is not going to cut it. What you should consider is, a program like NetSuite as an as an effective ERP that's going to, yeah, it'll be, you might look at it and think, oh, this is going to be a little expensive. But at the end of the day, if it meets your needs and enables you to scale, uh, I would take the investment any day. So that's year one. Year two, well, you're going to need to train the staff on the new systems. And you might be thinking, okay, why is it that, we have year one, we're doing this in year two? Well, because the reality is you're going to need, when it comes to the selection process, you need to select what's going to work. And this is where having a very thorough vetting process, having discussions with everybody. I mean, anybody who's going to be using this, I would encourage you to talk with in your business. Just get to the bottom of it, figure out what they need. And once you've selected that, then it's like, okay, let's begin the process of not only figuring it out, but then start training everyone on it. And then the next year is you're going to need to evaluate its effectiveness and then adjust. And the reality is at the end of the day, this is something that you're not going to just confine to year three. Just because of the way tech stack works, you're going to need to keep doing this. So even in year 30, you're going to still be doing this. Now, obviously, some additional things is, add a rolling forecast capability, at a quarterly at a minimum. Monthly would be preferred. And, I think eventually quarterly might be your best bet, because even though monthly would be helpful, I think especially for a larger business where, having 13 weeks of cash flow is really considered to be really a good forecast model, just being able to predict that. That's why even though having monthly can be very helpful, I think there are a lot of benefits to the quarterly too. And then obviously you need to train department heads on budget ownership. You may need to even give them some training on this new software as well, just to make sure that they see it. And again, the beauty of a lot of these programs is you can adjust it so that way people only see what they need to see. And then, you could, for bonus, which, will be really helpful, is conduct an internal practice quality of earnings to try to identify issues early. Always be proactive. I have never met somebody who was like, nah, let's not do that, who was never surprised at any point. The more proactive you can be on this, the better off you're going to be. So now, what we've done, let's take a look at the optimization phase. And, this is going to be something that, we may need to, it might be easily compressed, and we may actually be able even to start it in year three of the systematization process. But, start working towards implementing consistent budgeting practices and really streamline it. Now, you might be thinking, well, wait a minute, why is it we have all this stuff before it? Well, you're going to be learning, making adjustments. The reality is, once you're getting to year three and we're able to adjust, that's when you're going to be like, okay, we know what we need to do, and let's do this consistently. So use a lot of what is going on here as an opportunity to really gather data that you need to figure out what is the best and then run with it. And then, obviously work towards enhancing your variance analysis documentation, making sure it's very thorough and detailed. In addition to documenting, you may even have a place for recommendations like, okay, well, we had this happen, and the recommendation is just because of the increase because of inflation and cost of living, we should consider increases in the annual budget, just because otherwise we're going to be consistently having overages. Now, the management team should be able to present financials without the owner in the room. Maybe to the leadership team, or maybe just to themselves. But really what the point is we need to be able to get to the point where you're able to do everything independently of the owner. And then obviously really consider the sell side quality of earnings, which is going to be really key in the sale process. So let's talk a little bit about the due diligence timeline. The way that I like to work is I like to be working on gathering the due diligence materials when it comes to when we're getting the business ready to sale. So even before we officially bring in the M&A advisor saying, yes, we're ready, what do we need? I know what they want in terms of documentation. So really a lot of what we're going to be doing over the course of the first, over the, could be 2, 3, maybe even 4 years, we're getting this business ready to sell, is we're going to be gathering a lot of the documentation that we need. So that way, when it comes time for us to go to that M&A advisor, we're able to say, here is everything. Now, having said all of that, quality of earnings studies, it could be 30 to 45 days. And overall due diligence, it could take 3 to 4 months. So, obviously we're going to try to keep this as streamlined as possible. But the reality is when it comes to due diligence is there are variables that we cannot control. But the key one that we can control is preparation. Are you ready? I actually have a due diligence simulator in my exit planning tool suite that can point out if you actually, in fact, are ready. But, the way that we can make sure that the due diligence process is streamlined is if we have everything in order and ready for it. So, having said that, here is what you can do in order to make sure that you are as ready as possible. And let me do an immediate assessment. Can you produce last month's budget versus actual variance report within 48 hours? If you can produce it, I ask you and say, hey, let me go to my desktop. I can pull that up. You're in great shape. If you can't, then you need to, and you may even say, well, we do it by quarter. Again, no problem there. That's the point. Is if you can pull up a budget versus actual variance report from any period, that's not good. Now, does anyone besides you know why the variance has occurred? If it's like, say, for example, you'd say, okay, yeah, our CFO as well as our controller both know and understand that, and they also have the documentation. Hey, you're great. But if you're the only one, that's a problem. Now, have the department heads presented their budget results to anyone in the last quarter? Have they ever? Do you have department heads officially? If the answer to all of these questions are no, you're not ready. So here are some actions that you can take. For starters, document your current budgeting process. It doesn't have to be it doesn't have to be pretty. It's a starting point. The reality is when you engage Evan Duke Enterprises to help here, we're not necessarily asking questions because we're going to say, okay, you're doing it wrong. We want to know what you're doing because that way we know what you're doing and then we can see not only what is being done, but what is not being done. It's not about necessarily what you're doing, but also finding out where the critical gaps are. And the way we find that is by figuring out what is in place. If there's nothing in place, well, okay, yeah, we got to start from scratch. But most likely there's something in place. It could be even something as simple as I jokingly mentioned about Dave Ramsey at the beginning. It could be as simple as, say, methods by David Ramsey. If that's what you're doing, great. Put that all down so that way we can have that. Then, next step, identify who in your organization could own department budgets with training. If you don't have departments, well, most likely you actually could break things down into different departments. Do that, and then appoint people to have ownership. And then, next step, calculate your budget accuracy score for the past 12 months. And, it's it may not be pretty. And in case you're wondering, the formula is your total actual divided by total budget. Um, hey, if it looks really ugly, hey, understand why. Figure it out. The more you figure out and the more you understand, the faster you will fix it and get something better in place. Now, I've talked a lot about budgeting and the controls. And, here is the fractional COO offer. If you were to engage me and, it's basically you and a right-hand man who probably would wind up being promoted to the CEO role, one of the big things that I will work towards is, not only developing this process, but what we're going to need in your big company likely is we're going to need to, get a controller. And, if that controller, if you already have a good bookkeeper who not only shows a lot of skill as a controller, but also likely could be a CFO, we're going to probably promote them up to CFO. But we're going to need to get a CFO and controller here to build out the finance team. And, we'll have, likely an accountant as well as, eventually, like maybe a senior and accountant, and then, flesh out um, the payables and receivables team, as well as HR. But basically, the point I'm talking about here is this: is my goal is to come in and help get this in place, but really quickly get the right people in place to do this. Because even though I'm a COO and I understand a lot of this, there are a lot of other things I'm going to be doing. But my offer to you is that I will come in, get this not only straightened out, but also make sure we get the right team built out. And not only on the financial side, but also make sure we have the right department heads who are in control of the budget. So, having said that, that really is what you can expect when you engage a fractional COO. We're all about operations and executing. Obviously, financial reporting is key, but it's all about getting things fixed and really getting things built out. We'll be evaluating budget systems and financial controls, founder dependency. Really, the goal is going to be towards getting this budget process built as quickly as possible and instituted, and then really develop regular exit readiness reviews. This is going to start out in the form of the 90-day progress report, but then it's going to turn into monthly progress reports, as we're really, our focus is going to be how are we getting closer and closer to the process of exiting. So you may have heard a lot that you like. Let me just lay out for you what you probably need for your next steps. Maybe you just want to talk. Well, on my website, you have the ability to schedule an appointment. We can talk and, discuss things, and, you're not obligated. But if you like what you're hearing, what we can do is we can, come in and, really help get your business ready. And one of the key areas will be getting a proper budget development and control process in place. And then, really, the key thing at the end of the day is the goal is to not only offer actionable insights, but the beauty about being a fractional as opposed to a consultant is consultants just simply offer advice. They don't get a chance to own it. The reason I like being a fractional is I get to come in and I get to actually not only offer it, but say, hey, if you want to do this, I'm here to help you out. This one day a week, I want to help you out and make sure you get where you need to go. So, financial insights when it comes to exit ready business, really understanding the critical statistics is essential. This is a very difficult process. 30% of businesses sell. Sometimes I've seen numbers as low as 20%, but you know, and when you get down to it, in that 30% that actually do sell, which it could be as low as 20 depending on the year. 2 to 3% of business owners are satisfied. I don't know about you, but those are some really alarming statistics if I'm a business owner wanting to exit. And just seeing those key statistics emphasize why differentiation, really positioning yourself as well as possible, is important. So, if you have heard this webinar and decide that, yes, this is what you want to discuss more about, I would love to have the opportunity to sit down and talk with you. You have my email information, LinkedIn, we can connect. You have my phone number. Feel free to contact me. And really, my goal at the end of the day is to make sure that regardless of what situation you are in, we're able to get you on with the right plan and on the right track. But also, most importantly, that you are well positioned long term. So that way, um, you can be successful as you try to begin your next chapter. Thank you again, and I would love to talk with you all at some point very soon.